What if I told you that earning regular income from the stock market doesn't always require selling your investments? Imagine owning shares of strong companies that reward shareholders year after year by sharing a part of their profits through dividends. Sounds attractive, no? But here's the real question. Are all high dividend stocks worth buying? Or are some companies offering high dividend yields simply because their share prices have fallen sharply? More importantly, is this the right time to invest in dividend-paying companies? The Business Standard Dividend Dashboard, dated the 27th of June 2026, attempts to answer these questions by identifying 10 companies that currently offer attractive dividend yields. The list includes well-known companies such as Tata Consultancy Services, Coal India, ONGC, ITC, Power Finance Corporation, Central Bank of India, NMDC, Hero MotoCorp, Indus Towers, and Castrol India. In today's video, we will analyze each company in detail, understand why it appears on this list, examine its strengths and risks, discuss whether the dividend is sustainable, and explain what every long-term investor should know before investing in dividend-paying stocks. Stay till the end, because I will also explain why a high dividend yield alone should never be the only reason to buy a stock. What is dividend investing? Before analyzing these companies, let us first understand what dividend investing actually means. Whenever a company earns profits, it has several options. It can reinvest those profits into expansion. It can reduce debt. It can keep cash reserves. Or it can distribute a portion of those profits to shareholders. That distribution is called a dividend. Dividend investing focuses on owning companies that consistently share profits with shareholders while maintaining a healthy business. However, a high dividend yield does not automatically make a company a good investment. Investors must also evaluate earnings growth, cash flows, debt levels, capital allocation, and future business prospects. Why are dividend stocks becoming popular? According to the Business Standard Analysis, dividend-paying companies have attracted increasing investor attention because they offer both potential capital appreciation and regular cash income. During periods of market volatility or uncertainty, dividend-paying companies often provide relatively greater stability. Companies with healthy cash flows and disciplined capital allocation are generally better positioned to continue paying dividends over long periods. This explains why many long-term investors include dividend-paying stocks in their portfolios. Analysis of Tata Consultancy Services. Tata Consultancy Services continues to remain one of India's largest information technology companies. The company has a long history of generating strong cash flows and rewarding shareholders through regular dividends. Despite short-term challenges in global IT spending, TCS continues to maintain healthy profitability and a strong balance sheet. For dividend investors, consistency remains one of its biggest strengths. However, future dividend growth will depend on recovery in global technology spending and client demand. Coal India. Coal India remains one of India's highest dividend-paying public sector companies. The company benefits from strong cash generation and relatively low capital expenditure requirements. Government ownership has historically supported generous dividend payouts. However, investors should monitor coal demand, government policies, environmental regulations, and future production growth. Oil and Natural Gas Corporation, ONGC, benefits from strong cash flows generated through crude oil and natural gas production. Dividend payments are often supported when crude oil prices remain favorable. However, profitability can fluctuate depending on global energy prices and government policies. Energy sector investments therefore require monitoring commodity cycles. ITC has traditionally been one of India's favorite dividend-paying companies. Its diversified business includes cigarettes, FMCG products, hotels, paperboards, and agriculture. The company continues to generate significant free cash flows, supporting regular dividend payments. At the same time, investors should monitor regulatory developments affecting the tobacco business. Power Finance Corporation. Power Finance Corporation has consistently rewarded shareholders with attractive dividends. Its business benefits from financing India's expanding power and infrastructure sectors. However, investors should also evaluate credit quality, interest rate movements, and government policies affecting the power sector. Central Bank of India. The banking sector has witnessed improving profitability over recent years. If earnings remain stable, dividend-paying capacity may continue improving. Investors should monitor asset quality, loan growth, and capital adequacy before making investment decisions. NMDC. NMDC operates in the mining sector and generates strong cash flows during favorable commodity cycles. Its dividend-paying ability largely depends upon iron ore prices, production volumes, and profitability. Commodity companies can experience earnings volatility. Therefore, dividend sustainability should always be analyzed carefully. Hero MotoCorp. Hero MotoCorp remains one of India's leading two-wheeler manufacturers. Its asset-light operations, strong cash reserves, and disciplined capital allocation have historically supported regular dividend payments. Future growth will depend upon demand recovery, exports, and electric vehicle strategy. Indus Towers. Indus Towers generates recurring rental income from telecom tower infrastructure. Stable cash flows make infrastructure businesses attractive for dividend investors. However, investors should monitor tenancy growth, telecom industry consolidation, and customer concentration. Castrol India. Castrol India has maintained a strong dividend history due to its asset-light business model and healthy profitability. However, the long-term shift towards electric vehicles may gradually influence lubricant demand, making future business diversification important. How should investors select dividend stocks? Instead of looking only at dividend yield, investors should evaluate earnings growth, free cash flow, dividend payout ratio, debt levels, return on equity, management quality, future business prospects, valuation, industry outlook, dividend consistency over multiple years. A sustainable dividend is generally more valuable than an unusually high dividend that may not continue. The Business Standard Dividend Dashboard, dated the 27th of June 2026, highlights several companies with attractive dividend yields across different sectors. However, successful dividend investing is not about chasing the highest yield. It is about identifying financially strong companies that can continue generating profits, maintaining healthy cash flows, and rewarding shareholders consistently over many years. Dividend income should complement long-term wealth creation rather than become the sole investment criterion. Before investing, always evaluate the company's fundamentals, valuation, growth potential, and dividend sustainability. If you found this detailed analysis useful, subscribe to Suffer or Seek Knowledge for company analysis, stock market insights, dividend investing strategies, IPO reviews, business developments, and practical investment education. #Disclaimer. This analysis is based on the Business Standard Dividend Dashboard dated the 27th of June 2026 and other publicly available information. It is intended solely for educational and informational purposes and should not be construed as investment, financial, legal, or tax advice. The companies discussed are based on the published article and should not be treated as buy or sell recommendations. Always conduct your own research and consult a qualified financial advisor before making investment decisions. Disclaimer. The content published on Suffer or Seek Knowledge is intended solely for educational, informational, and knowledge-sharing purposes. The views, opinions, analysis, and discussions presented on this channel are based on publicly available information, official disclosures, applicable laws, regulations, financial statements, annual reports, stock exchange filings, and other reliable sources believed to be accurate at the time of publication. The information shared on this channel does not constitute legal, financial, investment, tax, accounting, or professional advice, nor should it be treated as a recommendation to buy, sell, or hold any security, financial instrument, or investment product. Company analysis, business news, stock market discussions, IPO reviews, regulatory updates, and corporate governance topics represent the creator's educational interpretation of publicly available information. Viewers should independently verify facts and consult qualified legal, financial, tax, or investment professionals before making any business, legal, or investment decisions. Investments in securities and financial markets are subject to market risks. Past performance does not guarantee future results. The creator and suffer or seek knowledge shall not be responsible for any direct or indirect loss or damage arising from reliance on the information presented on this channel. This channel is independent and is not affiliated with, endorsed by, or representing any company, stock exchange, regulatory authority, government body, listed entity, financial institution, or professional organization, including but not limited to SEBI, MCA, RBI, BSE, NSE, or any other regulator. All trademarks, company names, logos, and brand names mentioned or displayed belong to their respective owners and are used only for identification, commentary, reporting, criticism, review, or educational purposes where applicable. By viewing this channel, you acknowledge and agree that the content is intended for educational purposes only and that you are solely responsible for your own decisions and actions.